While we are getting everything set up, I just wanted to thank everyone for joining. If you have any questions that you want to ask during this meeting, you can use the Q&A feature in Zoom. So just click on Q&A and then you can put your question in there. And we will do our best to get those questions over to the panelists as they are talking. Okay, so I'm going to pass it over to Aaron Gillum now, and he's going to be the leader for this meeting. Thanks, Aaron. I think you might be on mute.
Okay.
Now I can hear you.
Yep. I say some of my best stuff when I'm on mute, so thank you. I hope everyone can hear me just fine now. Welcome, welcome. This is a little different for the Venture Club of Indiana, doing a virtual event. Those of you who are accustomed to our monthly networking luncheons and meetings that we have in downtown Indianapolis, I hope this transition, is sufficient. We actually did not have a meeting scheduled in April. And so we thought we would actually use this opportunity, especially considering everything that's going on in the world and in the country with this COVID-19 pandemic, to, maybe stop and invite some friends, some venture friends from around the region, around the country, to come and share with us kind of what they're seeing, in their portfolios, so that we can really understand, what this pandemic means from a venture capital and from a startup perspective. And so with that all said, I'd love to just take a quick moment to let our panel introduce themselves. I'm going to let them do it in alphabetical order. So Max Brickman, if you would go ahead and kick us off, please.
Great, thanks. So I'm Max Brickman, founder of Heartland Ventures. So I started the fund about 3 years ago in South Bend. So it's kind of up north from, I think, where most of you are. It's not a typical place to start it, so we kind of take a different view where we feel there's a gap between industry and tech hubs, primarily between a lot of these family-owned businesses that are in the Midwest. So we invest where there's an opportunity to connect technology companies with industry. So all of our investors in our fund are basically 30 of some of the larger family businesses in Indiana. So a lot of manufacturing companies, logistics companies. We invest where there's an opportunity to connect the technology startup to the business that's an investor in our fund before we actually invest. So if we can add value, if we can line up customers and validate product market fit, that's really where we come in. So we're a kind of a seed and series A fund, and we'll invest between 500,000 and $1 million.
Nice. How about Ryan Brochard, if you want to go next?
Sure. Everyone hear me all right? We're good. Hey, I'm Ryan Brochard. I'm based in Minneapolis, Minnesota, and I'm with Matchstick Ventures. We're an early stage seed VC that invests all across the north, which was basically Minneapolis to Toronto and nearby, across the Rockies and across the Techstars network. So we're on our second fund. It's a $30 million fund, and we're writing checks somewhere between $500,000 and $750,000 from there. And when we look at companies, we're always looking at looking for the founder connection that we have with them early. They usually have some sort of traction, and the team is in place. So. But anyways, very excited to be here. I made multiple investments in Indianapolis and looking all across Indiana as well.
We can't hear.
Fallon, we're just going in alphabetical order. Yeah, I was going to say, yep, you're up.
Hi, my name is Fallon Donnie. I'm a partner with Narya. Narya is a brand new Series A fund based in Ohio that invests across the country, but primarily focused in undercapitalized regions of the country. We're a hybrid fund. We'll invest in IT companies as well as life sciences companies, and our target check size is between 5 and 15 million for a first investment.
And Ryan Ziegler, last but not least.
Sure. Thanks, Aaron. Welcome, everybody, and thanks for having me. Ryan Ziegler, I'm a general partner with Edison Partners. We've been in business for about 33 years. We're based in Princeton, New Jersey. We're typically B2B software investors with a growing small consumer orientation when we have conviction and understand the industry. Typically a growth capital investor. With that said, we will write checks between $3 and $30 million. So over time, we've invested in about 250 businesses, had 180 exits. We're investing out of our 9th fund currently. We do love to go to underserved markets because we believe that scarcity of capital builds better businesses, and partner with entrepreneurs that have built customer-funded businesses and want to partner to help them think through the next stage of growth and build around them. So we sort of have the apparatus and infrastructure through our platform called the Edison Edge to make that happen in partnership with the entrepreneurs we work with.
Okay, nice. So we're taking advantage of the fact that we're all virtual and working from our living rooms or, home office or wherever you may be, to have some of our friends from out of state participate with us. So this is great. Would love to kick this off just at a high level, and I'd love for each of you guys to comment, to provide, just maybe your high level thoughts on what you see as the current state of the venture capital market. I'm not asking you to make any predictions yet, but just kind of what you're seeing, over the last month, first quarter, and so forth in terms of, your company's raising money, for those of you who are raising a fund, what that's like, the investments that you're making right now, the pacing. I'm just going to go back in opposite order and let maybe Ryan Ziegler go ahead and start, if you don't mind.
Sort of chaos, I guess. We're all trying to make sense of this. None of us have the answers, right? This is unprecedented. A lot of us have been through cycles before, and this is one that we've never seen because of the healthcare and personal implications. And not alone, this is one of the probably deepest recessions we're going to go into in a matter of time. So its implications on our portfolio and rippling effects, we're still trying to analyze and understand just at a practical level. I think, most businesses are okay, trending through mid-March, and then things started to trail off, depending on sort of, sector exposure, customer, sales cycle, and what industries you're in. Each business is sort of situational. We are seeing some countercyclical upside trends. Majority of the portfolio, yes, new sales are slowing down. And I think a lot of our time is spent right now on focusing on our portfolio 100% of the time to make sure that they're resilient, make sure they understand sort of what's ahead of them, and sustaining through this cycle where none of us really understand how long it's going to take. With that said, there is still business being done. But because of all the disruption, I think there's a lot of opportunity actually ahead for a lot of different businesses to pull through pretty strong. But again, it's a little early in that cycle. So I think if deals are in market, we did sell 2 businesses in the past month, but those deals had been in process for 3 to 6 months in advance. I think with that said, a lot of deals that were mid-flight have been pulled or retraded, candidly, that we see out in the market. And similar to the fundraising environment, I think it's just going to take longer to make decisions on the buy side in terms of even for funds as well as portfolio companies that are out there.
Okay. Fallon, can you maybe share your high level thoughts on what you're seeing in the marketplace now? You're on mute. Sorry. Yep. No.
Getting through the SBA process and some of the programs that the state of Ohio is putting together has been, certainly taken up a lot of time and a lot of bandwidth for VCs, across the country and here in Ohio, especially with the state of Ohio programs. I think, from Narya's perspective, we're a brand new fund, starting to build those relationships with portfolio companies across the country. A lot of the work that we were doing in the early days is remote because we're based in Ohio and we're looking at companies in all parts of the country. And so for those first introductory calls, a lot of those were done over Zoom and over phone calls anyway. But we're continuing to be as active and looking for deals as we were pre-COVID. Just doing it from, our dining room tables as opposed to out of our office. But, generally I wouldn't be, comfortable making any broad predictions, but obviously as we've seen, history repeats itself. The markets tend to slow down, and it remains to be seen what it'll feel like to be out fundraising, in the months and maybe even years to come.
Okay. Yeah, we're going to save the predictions to the end. I always ask prediction questions at the end.
Great.
Minneapolis, Ryan, you want to maybe tell us what you're seeing with your, what you're seeing out in the marketplace?
Yeah. So we see clearly seen a flight towards conservative nature of cash flows, and everyone realigning their projections for the year. Kind of interesting timing of most of our Q1 board meetings were in mid-January, maybe late January, and a lot. COVID was not on the discussion, and then having emergency board meetings basically, 3 weeks later to realign everything around kind of this new normal. But we were very fortunate. We were kind of predicting that there's some sort of downturn in the coming years, so we had plans in place for most of our companies, and most of the companies had capital because they had raised within the last 6 months from there. And so, we felt really good about kind of where those trajectories are, but we're just starting to see now the revenue hits come back to that, where some of the vendors and or potential customers are just flat out saying they're not going to pay receivable or payables for a few months. And, them having to delay that, even if it is essential, and a lot of the non-essential stuff, just being put on hold until the dust settles here. Some of the stuff that does seem to be still ticking in the market is less revenue generation and more cost savings. Like if you can help a company with cost savings, it's actually starting to hit, which is kind of counter-cyclical. It makes sense in this cycle versus usually it's revenue growth if it's in the B2B. So we're seeing quite a bit of that in the market here. But yeah, I think 2020 is going to be a year of survival for our portfolio. We've been saying that, 2020 is not the year you're going to get judged on for growth. It's going to be the year you get judged on how much cash you have in the bank in January of next year. Because if you can just survive and or if you show growth, based on what your company is clearly, but we feel like it's hard to invest in growth when all the indicators are really negative right now.
Yeah, cash is king, as they say, right? Matt,
Right.
You want to maybe share your thoughts here?
Sure. I think that's well said, Ryan. We saw an initial actually spike in companies kind of rushing to raise right when this was starting to happen. I think anyone that was looking to raise in the next 6 to 12 months was concerned that they didn't know how long this was going to last and kind of rushed to the market. I think there's a lot of capital deployed then. But Ryan, to your point, that's because they were still trailing. They were still growing. So you could still look at the prior couple of months and see good progress and try to get in on a deal maybe you couldn't otherwise get into and maybe get a slight discount. But now in a couple of months, everyone's going to be investing in something with negative growth or flat in most cases. So it'll be interesting to see. Making any predictions, but what we're there hasn't been that much money taken off the table. There's so much capital out there, and a lot of it is committed. So we're not really expecting to see any valuation declines we haven't really yet, and we haven't seen any yet. We're not really expecting to see any yet beyond 10, 15, 20%. But we're starting to see some corporate venture pull some money off the table because their core business has been impacted, and we're kind of expecting to see more of that. And since so much of the venture market has been, a lot of it's been driven by corporate venture over the last couple of years, and if a lot of that money gets taken off the table, it'll just be interesting to see what happens.
Yeah. No, and that makes perfect sense too. This will probably be the only question that I try to comment on and put my 2 cents from an investor in venture capital firms, I get the question a lot, like, are we still busy? You know, what are we doing at 50 South? And it's interesting, you know, we invest across all sectors and we invest globally. So from that standpoint, it's kind of funny that, you know, we're looking at probably 4 or 5 venture funds in China right now that are all back online. And so, you know, you'll see we're not making any trips over to China, but you are seeing, you know, more deals getting done in that part of the world. From a sector perspective, you know, tech investing, I expect to slow down a bit, especially on the enterprise side, just because there's no one to sell to right now. Everyone's working from home for the most part. But from a life science standpoint, it's kind of twofold. You had companies that were maybe public companies worth, you know, 600 million, 800 million, you know, in February of this year, and that same company today is now worth 200 million, which is an opportunity if all the business fundamentals remain the same. On the earlier stage, though, in life science, companies that are focused on preclinical or early stage, you know, therapeutic and so forth, I don't think you're going to be able to find too many patients that want to go sit in the hospital voluntarily right now to go do a preclinical test. So a lot of those testings have been pushed for at least, you know, 3 to 6 months or most likely through the end of the year. So, you know, we're seeing it run the gamut. It really just depends on what sector you're focused and what you're seeing. I want to just do a quick intermission here. We've got about 150 guests on the phone on the connection right now. As Chelsea mentioned at the beginning of the call, you can submit any questions using the Q&A button at the bottom of the Zoom participant link. Just go ahead and type in your questions, and we're going to leave plenty of time for our panel to discuss that. The next question I had, and I wanted to be a little bit more specific to your kind of how you're working with your portfolio companies through this period. You know, if each of you could just think of maybe 1 or 2 things, you know, observations that you've seen from your portfolio specifically. So think of the companies that you've invested in. You don't have to name the name of the company, but it'd be good to say it's in the restaurant industry or it's in the enterprise software industry, and just maybe tell us kind of, you know, have they made that transition to the work from home pretty smoothly? You know, they've been negatively impacted by the economy. Are they benefiting from it? You know, just go ahead, maybe and cite 1 or 2 examples. Max, if you wouldn't mind maybe kicking us off here.
Sure. So we kind of have one of each, one that's been impacted more and to the negative side, and one that is actually kind of benefited from all this. The one on the that, you know, is kind of stagnating a bit is in the HR space. Nobody's hiring. It's a platform for hiring hourly employees through text for blue collar employees, and no one's hiring. So, you know, and you can't sell anything. No one's taking meetings, to Aaron's point. So it's really plateauing. But we're still incredibly bullish on that space because long term, you know, we're expecting to see, you know, when companies come back online, if you're a manufacturing company, and there's a lot of the companies that we work with that are LPs in our fund, if you have 1,000 employees and your employees have been out for 2 or 3 months, it's a long time. And it's not really reasonable to expect you're going to have all 1,000 come back online, you know, the day you open. You know, you might have only a fraction. So we're still very bullish on hiring, on training, on anything to do with HR, because we think when it comes back online that you're still going to have a bit of kind of disruption of people changing jobs and need to retrain. On the positive side, we have a company that has a kind of a differentiated approach for automatically taking phone orders for their kind of beachhead market is the pizza industry and restaurant space. So they've obviously done incredibly well. I mean, they've, you know, doubled in the last couple of months, or the last couple of weeks actually. So you have, and that's kind of what we're seeing across the board, both with our investors that own manufacturing companies and our portfolio companies. There's this huge spectrum and impact. You have hospitality that's impacted 100%, and then you have some industries, you know, including logistics and certain manufacturing sectors that are actually benefited from it. So it's kind of different than 2008 in that the spectrum is just really extreme.
Yeah, that's good. That's good. Brian in Minneapolis, would you mind maybe sharing a couple of examples from your portfolio?
Yeah. So when we've been spending an insane amount of time with each one of our founders, basically on a weekly basis. And I talked about the cash flow stuff that we've been working through. And I think that's pretty straightforward. But one of the things that we've been trying to spend a lot of time with is the like human beings involved in this. Like it's been a huge emotional impact. A lot of times we have first-time founders who haven't gone through this before. So we've been trying to be super supportive of them, helping them become leaders and step up to this occasion, because we know that great companies are made and great leaders are made in hard times. So we've been trying to help them, through that, and starting to see the second level impacts of like them and their employees, and maybe their employees' spouses who are being let go, and now they're dependent on the startup to survive. And there's just a lot of dependencies that come through there. So we've been trying to help them through that. On top of the cash flow, making sure they have capital, make sure they closed on any capital that they have available. We have same kind of handful of companies that are really doing really well. One in the restaurant space as well that does online ordering. They are just exploding right now, clearly. And we have one that's in the transportation that works with airlines, and their business has gone to 90% down right now. Even though they have a ton of capital, they're totally fine on that regard. There's just no reason for them to spend this capital when no one's literally moving. It's kind of on both ends of it. But the thread that we try to have through all of this is just like, how do we help the founders lead their companies better?
Nice. Fallon, as a newer fund, kind of what can you maybe talk about what you're seeing either from your most recent investments, or if you want to speak more broadly, just feel free.
Yeah, both in terms of companies that I've invested in, or just in terms of CEOs that I've become friends with over the years. I've been really impressed with the way that these individuals have stepped up to the plate in this crazy time. Some of them are really even thriving as a wartime CEO. They didn't know what they were capable of, and I've been really impressed with their ability to pivot quickly. One of the companies I had invested in lost almost all of their revenue overnight. They're a mobility company that focuses on moving people from their homes to their office, and people weren't doing that anymore. And almost immediately they pivoted to picking up prescriptions at pharmacies and delivering them to sick people in their homes. And so I've been really impressed with their abilities to turn things around, to navigate this crazy federal loan program, to navigate the state programs, to furlough or lay people off in a thoughtful way. I know that wasn't easy, and especially as this indicated before, a lot of these CEOs are very young and they didn't go through the crisis of 2008 or 2001 or anything of this magnitude. And I've been extremely impressed with the leadership teams, and really all of the teams, and their ability to step up.
Yeah. Ryan Ziegler, kind of going off of Fallon's point about wartime CEOs. I mean, you're probably the latest stage investor on the phone today. So I don't know if maybe you could share kind of the difference in your portfolio from those who've been through these types of, economic cycles before versus those who this might be their first time, ever having to lay off somebody or lay off a team for that matter. I don't know if you can share your thoughts on something like that.
Yeah, it's been extremely difficult. I think the majority of companies have made cost reductions to fight to win another day. So walking through that for us and doing it in a humane way is really important. So being extremely transparent with empathy and humbleness is really important right now. I think people understand the severity of that, but you don't want to take it home to every household. And that's what we're trying to be very thoughtful about. So, it's not just cost reductions, it's sort of balance sheet protection and how we think through each of that and its matriculation from the board down to the management team. So for us, the call to get, frankly, 18 to 24 months cash is something we're solving for right now. And some businesses are able to do that. Some businesses are not able to do that. Therefore, we're going to go to insiders and figure out pretty quickly, support around the table and drive alignment, how we want to run the business. I think in a lot of scenarios too, we want to be thoughtful about where we want to make investments. So we're thinking through issues around the new normal around behavioral change of how business is done, especially from work from home. The majority of our businesses, thankfully, were pretty strong work from home posture. We're even having discussions of whether they go back to their office space in some scenarios because they are managing through this even at scale, and there's implications around that. But I think they're readjusting their decision frameworks around go to market, and most importantly, it's a time to double and triple down on product and your product roadmap. We're seeing sort of nice to have versus must have really show through in the market right now. But even if you're nice to have, it's a tremendous opportunity to get even closer to your customer. Retention is the new acquisition, and really over deliver to let your customers build that muscle up and focus your product roadmap. That if new sales are not coming in the door quickly, it is a time that we're actually increasing product investment in R&D across the portfolio right now in terms of where we're spending money, because now's the time to do it. And really stress test your value proposition and where you can adjacently grow or land and expand, in the industry groups you're in. We have some businesses, I would say 20% of our companies are finding a lot of growth in this environment, and 20% have to really manage through a really tough situation. And I'd say the 60%, have the opportunity to reset a little bit, and get through the other side and start to grow again.
Nice. So we've got probably 8 or 9 questions that have come through, and a couple of them have been around, anyone who's been following the news the last couple of weeks, you've seen how the federal government has tried to put together a comprehensive response through the Personal Paycheck Protection Act, as well as Small Business Association Administration loans. Ryan, you and I actually had a discussion about this, 3-4 weeks ago when it was still really early. I don't know if maybe you can share a couple of your thoughts on what the program looks like today, and are any of your companies, have they been able to access these funds? Sorry, Ryan Ziegler. I forget. We have 2 Ryans.
Yeah. You don't want to be there. Yeah. So
I was looking right at you though.
Yeah. It's incredible. So we created a COVID response team. We actually consolidated all our legal response to this to one firm that's helping coordinate, because we have 50 companies. And I've been delightfully surprised at the speed in which the government has put this together, and it is very impactful. There's a lot of considerations that need to be made, around this, based on access to capital, as well as the specific company situation. Have they taken all the factors in place in terms of they really need the funds from a necessity standpoint? So I think it's really important to have those discussions at the board level. But to answer your question specifically, yes, our companies have applied, and some companies have already been funded. About a dozen companies have already accessed funds and gotten them. So the banks in which they partner with, most of our companies have a pretty significant banking relationship. They're not levered, but they do have facilities, let's say anywhere between 5 and 15 million. Those banks have been instrumental in helping navigate it pretty quickly. And then we're seeing response rates in terms of applications between 2 days to a week now, in terms of applying to getting funds. So it is working for the right situations and getting through, but just having the right decision framework and governance over that's pretty important, because I don't believe all companies should access these funds. And so that's situational.
Yeah. Does anyone else want to maybe share a couple thoughts? I don't know if any of your portfolio companies are trying to access these funds or not. I'll let you go ahead and chime in.
Yeah, I'm happy to chime in here, the other Ryan. We definitely have companies who are applying for it, and it's been a bit of a mess. We'll say one thing that we have found is that, like, the community banks or the kind of more regional banks have had quicker access to the funds and ability to get it processed. Just that's an observation that we've seen. And second, one thing we've been advising our companies to do is have like a very clear like internal memo, board doc, or something saying like why you're accessing these funds and like what is the actual impact that COVID has had on this, and timestamp it, sign it, like have it in there in case you can imagine in the future there's some day where there's going to be an audit on this money or some news report or, something, and just being really smart about saying like why you took it, when, like what are the material impacts that you've had it, and have that timestamp. So we're going through a lot of that stuff right now. And honestly, it does make the founders really think through, should we be accessing this money? Like, do we really need it if we have 24 months of runway? It's like, well, I don't know if that's necessarily where this capital is meant for, but, make the case and then like, let's discuss it.
Yeah. Max and Fallon, I wanted to get your thoughts maybe on what creative ways you're seeing some companies either conserve cash, retain employees. Are you seeing your companies maybe cutting salaries a little bit and offering more equity? Are you seeing them just take broad swaths, out of the operating expense line? Just curious, kind of what creative ways are you seeing your companies conserve cash so they can keep the lights on and move forward?
We're seeing, I guess you can't really apply for PPP, or it's not going to be forgiven unless you retain all your employees. So I think it's actually been a good incentive to not lay anybody off. And just anecdotally, all of our portfolio companies have applied for it. There's a lot of uncertainty on, could venture-backed or private equity-backed companies do that? And in most cases, at least for venture-backed companies, they can. So all have been, and that's encouraged a lot of companies too. But what we've seen is a transition from more sales to product development. There's kind of not, you'd have to spend so much effort to focus on sales right now that it's, a lot of resources going to a very small amount of upside, when you could just refocus that talent on strategic goals or other projects that you maybe haven't gotten to over the last few years, or if it's been 2 years since you've really structurally changed the company and really thought about strategy and thought about what the next few years are going to look like, maybe your company is a lot different now than it was 2 years ago, not just because of COVID, but you're at a different place. So we've been encouraging our companies to look at this as sort of an opportunity where there are fewer distractions, where you can really focus on team building, on strategy, on just other projects that you could do that you might not have thought you had time to get to before.
Okay. Fallon, how about you?
Yeah, I'll echo that. We're seeing companies using this as an opportunity to reset, rethinking their leases. They very quickly were able to get a hold of landlords and renegotiate terms of their lease, working with other startup companies to share lease spaces and discussing ways that they can cut costs coming out of this crisis, where you're sharing with several other companies and perhaps you only meet in person on Mondays, and then the other company has the office on Tuesdays, and so on and so forth. Restructuring employee agreements, moving some people from full-time to part-time, moving some W-2 employees to 1099s, and just using this as an opportunity to reset things that maybe you wish you could have done a little bit differently, and using this as an opportunity to plan for the future.
Yeah. This is good. These are all great responses. I'm glad I have you all on the phone. I'm going to throw a little bit of a curveball at you. I know none of you are life science investors or healthcare focused investors, but I am curious if you've seen an uptick in the number of companies that claim to be, a solution for something COVID related, whether it's changed any of your investment theses or your strategy at all on investing. I see Fallon shaking or nodding her head, so I wasn't sure if you had something to add there.
Well, Narya is a life sciences fund. We'll focus about 50% of our time on that because my partner Colin is a life science investor. But regarding the COVID inbound cold emails that we're receiving to our through LinkedIn and into our info at Narya VC account, there are a lot of COVID response companies that are popping up, a lot of COVID response accelerator programs that are being proposed. So definitely seeing a large influx of that. And that's something to really think about, because obviously as a venture investor, we're thinking about companies that will impact the next 5 years, 10 years, 15 years, and not having any idea how short-term or long-term COVID is. It's certainly not been a focus area for us, but we are seeing a large influx of proposals.
Yeah. Anyone else seeing an uptick in the number of healthcare or telehealth companies or anything related to the pandemic going on?
Yeah, I would just comment. We have a telehealth business that literally has tripled in a quarter. In terms of what's happened is that a 2-year sales cycle has literally become a week or two. which is kind of incredible. There's two sort of situations going on though, in that, the tele anything is going to be, very strong right now, but anything actually in the elective service side has been shut down, obviously, and folks that need to do business in the hospital, that's slowed down tremendously. Folks are staying away from that side of the equation. We've also seen a big uptick just in anything that's sort of enabling digitization and essential goods. So in supply chain and what's happening, there's just a huge focus, public and private partnership, obviously, that's going on now, an influx. And then we're just seeing anything related to sort of the infrastructure around digital commerce and providing that in the new normal is extremely strong and focused. And then the last is, I hate to say it, but in times like this, criminals don't go away. They actually increase activity. So security is really important in what's happening. And I think one of my colleagues mentioned here earlier, anything to do with cost containment is coming to the top of the pile in terms of actioning on and selling through in a lot of the industries that we're involved with.
Nice. Makes sense. Ryan or Max, did you guys want to add anything?
Yeah, so we haven't seen a lot of companies that are claiming they're targeting COVID, but we've seen a lot of our existing portfolio companies try to suggest how their current product could help COVID and actually giving the product away for free, since they can't really sell anything now, as a way to kind of get their name out there and build relationships with customers, sort of to find applications for the product and help companies that are impacted by this, whether it be healthcare or anything else. And then we are seeing a bit more on the telehealth side, on the behavioral health side and mental health side, an uptick in need for that because of just the amount of isolation, but also the availability of funding for it. So Medicare and Medicaid has never paid for behavioral health, telehealth within behavioral health before, and that wasn't supposed to happen for a while, except in a few states, and now on a federal level it is. So now there's this, and it's not clear if that's going to stick or not. But now all of a sudden you have this new market that's just appeared, and funding available for, or reimbursement costs at least available for that, which creates a lot of opportunity if you're in that space.
Okay. Ryan B.
Yeah, I would just reiterate, like, we have a couple of companies that are selling into healthcare. They're not providing the services. We've seen the same thing where the sales cycles have just been chopped down to like couple weeks, and in an industry that's notorious for long sales cycles, to come down like that is pretty incredible. The one comment I will make is, like, we have seen so much, instead of like Uber for X, now it's like something for COVID, like all this stuff. And to us, we want to see companies that have like long-term, like can solve a lot of problems, over a very long time. So it's kind of a turnoff for us if we think someone's just going to opportunistically, jumping on it, and or, trying to jump on more of a marketing push than anything for their companies. But if it has a real impact and they can demonstrate it, then, we're all for it. But it just seems like there's a lot of noise around that, where everyone's just kind of throwing that on to, oh, and we can do this, or we would have predicted this, or, all this stuff. So I don't know. I guess we got to take all that with a grain of salt.
Yeah. I have a two-part question for each of you, and the first one is a multiple choice. If someone asked you, are you still actively investing in the second quarter here, as we just started the month of April, would your answer be A, yes, same as usual, B, going slow but opportunistic, or C, call me in the fall? And then the second part of that question is, what are you telling startups, or how can startups get your attention today if they're looking for funding? Ryan Ziegler, I'm going to let you go ahead and answer the multiple choice question first.
It's B, but there's a practical, we're still in business and intend to, if we see something compelling, look for it. That's what we're paid to do. And our limited partners, we've had lots of conversations with them in the past several weeks, and they want us to be smart. So if there's something compelling, 100%. I think the practical implication of what's complicating this is we have to have a pre-existing long relationship. The physical interaction and working with a company at the stage that we enter really matters. So we are rethinking that as well. So the point is it slows things down as we try to work through that virtually. So I don't have an answer today other than it's slowing down for that reason. Unless we don't know you, we certainly will develop new relationships, but I don't think to the fall that would actually matriculate to anything. But if we do already know you, have spent the time, it is business as usual, but we're just going to be, have to be really convicted to move it along right now in the second quarter.
Okay. Max, you want to take a stab at that question? Multiple choice one first.
Yeah, we're just as active, okay. Arguably more. I think there's some more opportunities out there. I think being able to see how companies react to this and are able to handle this, are they seeing, kind of to Fallon's point of being a wartime CEO, you learn a lot about a company based on how they handle this. When things are going really well, it's easy to keep growing. To your other point about how to get in touch with us, I guess I don't see it any different than, since we're just as active as we were before, than during a normal time, which is, ideally through a referral, but we still respond to people that reach out to us cold. Definitely not opposed to that.
Yeah. Ryan B, Minneapolis, Ryan.
Minneapolis, Ryan, like that. Yeah, so we are definitely A. We actually have like 2 deals we're probably going to do in the next couple of weeks. Granted, they are ones that we knew a little bit at the end of last year. We've been kind of working on for a while, but yeah, we're still very active in that regard. And I would say, as far as get to hold of us, I think that's business as usual. I'll caveat that we're really big into since we invest so early, like we're really big into building relationships with founders first, like real relationships. So that entails like a lot of interactions and that typically has been in person because we're in our regions and, we get to meet them in person. And so we're adapting that to virtual now, knowing that, travel and in-person stuff is not happening. So yeah, we're trying to make sure that we can try to build those authentic relationships with them virtually. And I would say that it's going well so far with that, but that has been something we've had to adapt to.
Yeah. How about you, Fallon? Just as busy as usual, going slow, or, call you up in October?
I would say A, but I think everyone's made some great points. It is more difficult to build those relationships over a Zoom call. We intend to spend a lot of time in certain ecosystems, and this has prohibited us from being able to do that. There are certain technologies that you want to be able to evaluate in person. Maybe a hydroponic growth plant, that's something that you're going to want to be able to check out for yourself. And that's just tougher to do over Zoom, over a video. But Narya is a long-term focused fund. We originally planned to invest in 2 to 4 companies per year to spend a pretty lengthy diligence, on each of those companies. And like I mentioned earlier, we are going to do about 50% in life sciences, which is kind of a different animal and hasn't been very, as severely impacted as the technology side. So for the most part, with a few caveats, just like everybody else, we're business as usual.
Okay.
Aaron, just wanted to add one thing,
Yeah.
if you don't mind me jumping in. What's interesting, we're seeing sort of this environment breeds opportunity for a lot. We're encouraging our companies to really get close to all their competitors for obvious reasons, not actually to knife fight, to actually how can they collaborate together to raise the tide so all ships rise. So that's one aspect. But in addition to that, we do think it's an opportunity in the market where companies can come together to create operational scale. So we are encouraging a lot of our entrepreneurs to look around the market and see if there's interesting deals that can be done laterally and within their own markets.
Okay. No, this is good. We've got time for maybe a couple more questions. And if you guys have ever been to any of our events, I try to make you guys do at least one projection, or let's play 2021 and go into the future and look back for a quick moment. So if we were sitting here in April of 2021, a year from now, and I asked you to look back on the previous year with your portfolio companies, your investments, what would look different a year from now as opposed to today? Like, what could we expect? for how your business as usual is going to look 12 months from now. Max, if you don't mind, I'm gonna put you on the spot and let you go ahead and start.
I was hoping it wouldn't be that. So next year, I guess in terms of timeline, being one of the biggest things that's going to impact how companies are able to rebound from this. We'll probably expect, I don't know, mid-May, 1st of June, for ending kind of stay at home, and then we're expecting this fall to be kind of the first time people are really comfortable taking meetings on a kind of larger scale, where you're not kind of second guessing meeting taking, and assuming this doesn't come back and to this degree this winter, then most of the indications are saying it's not going to be till late next year until we have concerts and sports, which if you're in that space, you need to prepare for that. People that are reliant on revenue from conferences and events, and from musicians to entertain, a lot of areas that are impacted by this. So from a timeline standpoint, but there's a lot we don't know. Like we know pre-COVID and we know stay at home. We don't know going back into like what it's going to look like the next few months. I mean, Gavin Newsom, the California governor, saying, you might have to take someone's temperature before you can even walk into a restaurant. And so we don't know what this is going to look like. And if that's the case, it's going to be a lot longer. People are going to be scared. People are going to just be hesitant. It's just going to be part of everything we think about, for the next year. And I think that'll impact things more. And then, so yeah.
No, that's fine. I wasn't trying to cut you off. I mean, one thing I would add to that, Max, too, and for everyone on the panel, venture capital investing is a very long-term asset class, right? I mean, you're not going to see the fruits of your labor for, if you're lucky, 5 years, but most likely, 8, 9, 10 years or more. And so sometimes you wonder, how much do you focus on the current, the current cycle, the current market volatility versus just stick with your game plan and things should work out. So with that said, Minneapolis, Ryan, I'm curious, if we look back 12 months, what are you thinking, how your portfolio might look, your business strategy and so forth?
Yeah, well, it's the saying, it's difficult to make predictions, especially about the future. Yeah, I think the future for us is almost, day to day, if, week to week, if we're lucky, looking out. But yeah, if we're sitting a year from now, I fully suspect that by that time people are starting to reinvest in growth in their company, and it's kind of less putting out the fires. There's going to be a ton of uncertainty in the market, to what Max said around like the connection points of actually meeting in people, and who knows about the vaccine and stuff coming out. Hopefully by April there's something, or hopefully some hope there. I think in our portfolio, we're trying to help our companies get through 2020 with the expectation that 2021 is the time to then spend the money for the growth. And by then, indicators in the economy, but also in the psychology, I think, of a lot of people, hopefully will come to know that this is, if there is a new normal, it should be sunk in by then.
Yeah. How about you, Fallon? You want to do the 12-month look back with us?
Yeah, it's going to be a changed world. It'll be a different world 12 months from now, no doubt about that. And some companies will fail because of it, and some companies will thrive because of it. I can certainly convince myself that relaxing government regulations is going to be a very healthy thing for a lot of our companies. Capital efficiency is going to be a healthy thing for a lot of our companies. So I think it'll vary case by case. I'll be the 10,000th venture capitalist to mention that Airbnb and Uber were launched in 2008. We all know that. So some companies will thrive in this potential recession, and some won't. But overall, I really don't know. I wish I did.
Ryan, you want to make the final prediction for us?
Sure. Just in a couple different vectors, like on a product perspective, I think we're either going to consolidate products inorganically or be a part of that consolidation, just to be real about how this kind of plays out next 12 months. Scale kind of matters for sustainability and unit economics. I do think there's going to be a broad shift to inside selling organizations versus enterprise, and how that, we need to adapt to that to make it effective if you're selling big deal sizes. We don't have the answer just yet. One of the interesting derivatives that's happening is that recruiting and building teams doesn't need to be as regionalized. So we would always at this stage say everyone's kind of got to be together. What's becoming more clear is that we can recruit from wherever because of work from home and the remote. So the onboarding of those executives and how you do it successfully is really interesting, or how you transition a company that's historically on site to more from a work from home posture, which means to us even better talent across the board. And to Fallon's point, this is a true test of unit economics right now. It's going to flush out through the P&L and what it actually costs to do business and how good your product is. And couple that with the cost of capital is going up for a lot of reasons. So I would think it will drive more capital efficiency, but it will have impact on how businesses are built moving forward and the considerations around dilution and what success looks like. So profitability is the new measure, or a case to be made for that versus growth at all costs. So I think just the behavior, how you run a company and how you want to build it for sustaining value is changing right now.
Yeah. Okay. These are all great thoughts. All right. Let me, I just want to get you guys to maybe sum up with the closing 5 minutes that we've got here. Your prediction of, the venture capital space post-COVID. So not yourselves, but think about your peers, think about the industry in general. The last 10 years or so, we've seen a real nice bull market. There's well over 1,000 micro VCs now in the market. A lot of seed funds, a lot of new Series A funds. Everyone's getting more sector focused. I'm just curious, what are your thoughts in terms of how this industry might be forever changed in the future, or once again, maybe this is just a blip on the radar, and we'll just continue to move forward. So no particular order. Fallon, I'll let you go first, just because I think I asked you to this panel first.
Probably a blip on the radar. History tells us that, this is cyclical, and we could have expected that a downturn would come eventually. Things don't go up forever. With that said, over the next year, 2, 3, 4 years, I think it's going to be really hard to raise capital, especially as a first-time fund. Raising a first-time fund is very difficult anyway. Raising a first-time pre-seed or seed stage fund is probably even more difficult, because you're primarily raising capital from individuals as opposed to institutional investors. And when people, had a 30%, 40% hit to their net worth, they may be less likely to invest in venture, especially if they don't understand the space. So I think it's going to be tough. I think it's going to be tough for the VCs. I think it's going to be tough for the startup companies, but I think it's going to be short term.
Okay. Ryan Ziegler, would you mind chiming in? I think you're the furthest away of everyone on the panel. Travel-wise, yeah.
The most sophisticated investors in the world know right now is a wonderful time to invest and kind of double down if you have a long-term view. If you look at the vintages of 01, 02, and after the 08 crisis, those funds pretty much across the board have done phenomenally well. So there's going to be, certainly, I think capital is getting raised right now. There's a flight to quality. And I also think just who is funding our funds matter, meaning, I think public pensions have a little bit more tricky denominator effect to their allocation to private equity that affects us, that dries up some money, but it's still there, and we're talking to them. Foundation endowments sort of have weathered the storm. They built up proper liquidity to get there, but still flight to quality. But everyone, I think, is saying, listen, there's going to be a delay anywhere between 3 and 9 months on the current schedules. Otherwise, it's business as usual, and folks are hoping for, a strong V recovery. But who knows? That's debate over cocktails.
Yeah. Max Brickman, you want to maybe make your prediction here?
Sure. There's in the same way that there's going to be a test of startups, and there's going to be some weeding out of companies that don't have solid unit economics and that probably wouldn't have made it anyway. I think it's the same thing and going to be the case in venture with the actual funds, that there's a lot of funds now, and I think you're going to see, a thinning of the field a little bit. It's going to be more difficult to raise the fund. It's, it's easy to raise a fund when everything's going up. But I think, there'll be a thinning. I think the other thing that's going to contribute to that, again, I think, is corporate venture. That's corporate venture is backing a lot of funds. They're also investing on their own. I think you might see some of that drying up as these corporates can't afford to allocate that amount, to venture. They might, if it's not already a dedicated fund within the company, they might just pull that back onto the balance sheet, use it for something else. So that might, cause some, a kind of reduction in capital in the market.
Yeah. Ryan Brochard, you want to maybe take a stab at this 1 minute?
Yeah, and I think there's plenty of capital in the market right now. And for, I think, everyone on the call here, and what we see is, we invest outside of the coast primarily, is there's actually going to be more competition and, I guess, co-investing from coastal VCs as the work from home, remote stuff becomes apparent that you don't have to be located there to have great companies. We're already seeing this in Minneapolis and Denver, where a lot of the big name coastal VCs are actually coming in, or they don't have to get on a plane anymore, so they can't use that excuse of like not having to get on the plane because they can do it all virtual. So for us, we think near term that's great, like opportunity to co-invest with tier 1 VCs from the coast who are willing to invest outside of there more and more. Longer term, pretty interesting, right? That could become kind of more mega funds trying to cover much more of the country, and probably being able to do it, right? Because it becomes more virtual, their ability to find some of that stuff. So yeah, I think there'll be more geographic diversity for funds availability to meet with companies from all over the country.
Nice. All right. Well, listen, it is the top of the hour. I wanted to thank our panel. Thank you very much for taking the time to share your thoughts and your insights. Just imagine a virtual applause from the crowd right now. That's what you would be receiving. For everyone that attended today, we did record this session, so you'll be able to, we'll hopefully be able to send that out, and you'll be able to listen to this or share it with your friends who may have missed the event. Once again, thank you for coming out. Wishing everybody the best of luck. Stay healthy, stay safe, and take care. Thank you. Bye-bye.
Thank you.